Hello, everybody. My name is Brian Dunning from quantlabs.net. I just wanted to piece together something that's pretty important to me. Um, what I've noticed is over the last little while, a lot of people get caught up in technology, buzzy terms like high frequency trading, quant, software, all that stuff. So people get caught up, as I said, in shiny toys. And to be honest, I've been guilty of that for many years. But I just put up a series of very important postings in detail, in sequence on risk management. Now, if you ask me, the risk management is way more critical than all this other stuff. And I'm going to prove it to you that even though I had it wrong for a number of years, I'm starting to realize that all that stuff is probably the last thing you need to be considering, or at least it should be treated secondary. Now, no matter if you are a manual trader or a automated trader, I'm going to show you some things that will probably, hopefully, will jog a little bit of your brain on how you are conditioned as a trader, regardless if you experience newbie or not. All right, so these are my stats in real time over the last few hours. Now, nothing to get all excited about, but you'll notice these are usually the top 10 or whatever the top of the day is, right? So you see a lot of them are all based around technology, questions about technical analysis, but mostly about technology. I mean, that's what I've been focusing just to be fair to the situation. But specifically, I put this article hours before. Where am I looking for? Before. I'm looking for this one right here. Okay, so this one was posted hours before, and it's just basically, really I was hoping helpful for people how to apply psychology trading when you put your positions on. Critical reason why you need to automate. Okay, so that got some responses, but this one got more responses a few hours later being posted, and it rushed up the little ranking a lot faster. What happens when strategies and secrets of high frequency traders or trading firms get revealed? Now, I don't know if this rose faster because of high frequency trading, but if that was the case, or secrets or strategies over something as probably more important, regardless, as I said, if you're a newbie or an experienced trader versus an automated versus a manual trader, I would have thought this would have been easily one of the most popular articles I've done in a while. But no, this HFT one was more important. But it's a point that I'm trying to make here of this article, meaning your risk management is a hell of a lot more important than anything else out there when it comes to trading. Why, oh God, why are we being caught up in this stuff of high frequency trading, quant programming, all this math algo stuff, when we put this, the risk management, on the back burner? That to me is stupid, pure stupidity. And like I said, I'm going to be the first one to admit guilt on that, but let me just walk you through the topics here. And I'm putting this video together just so I can verbalize it faster instead of typing it. As I said, the applying the psychology of trading when you put your positions on, that goddamn is really important. You have to set parameters, know if you're going to apply maybe stop losses, when to apply your stop losses, know what to do when you're on the down, and what to do if you're on the up. Let's say if you're on the up, do you apply more to that position, and what do you do with the stop loss on the new position? So on and so forth. How do you calculate your exit? I can't explain how many times, and I've seen, articles go on about, your entry it should be this, and your entry should be based on that, some mathematical formula, or based upon some technical analysis indicator. To me, that's a load of bull, because now No. What is more important is your exit, because your exit is going to determine your profitability. So again, that is when you start applying these risk management analysis and parameters that are so critical to how you trade. Not only that, but I've heard about Kelly Criterion, and I thought, oh, Kelly Criterion, that's the only thing you have to apply to your risk assessment. That again is a load of BS. There's so many other factors you need to factor in. You use Kelly Criterion on your self-awareness as a trader. For instance, you use Kelly Criterion, your risk that and how you're doing on your winning versus your losing trades, and have some kind of process to determine your self-awareness, so you know how much to allocate on your next trade. Are you going to allocate more capital, or are you going to allocate less capital? Pretty critical stuff, if you ask me. Now, in this one, I posted about why the vast majority of retailer traders are losing money. And when I think about it, it's so freaking true. I go to so many groups talking to, let's say, retirees or people that get sucked into thinking that trading is the end all and being all to path to the riches. Dude or dudette, you are just getting sucked into this false dichotomy of thinking trading is that easy. Yeah, any monkey can trade in profit in mind, but to be honest, try it when the market goes sideways or when the market's in a losing position. What then? What do you do? And there's so many other factors that can wipe you out in seconds. I'll go to that in a minute. This one, you as I said, you need discipline as part of your risk assessment to ensure that you are a long-term profitable trader. I mean, I don't know. It's just things I never thought about. Another one. Let's say you are using Excel to calculate your long, short, and applying a beta across the entire trade, and then you can use that to hedge out your risk and minimize your risk, in other words. Pretty fancy stuff. What happens if you do that same kind of logic across multiple currencies or multiple countries? What then? How do you reduce the risk? So these are things that you would never ever factor. Now, I'm going to put this out as a caveat. This video is the only time I'll be talking about this. Risk management. Way more critical than any model, any machine learning process, or whatever you're going to apply. To be honest, these concepts I just listed here are what going to keep you as a long-term profitable trader. I don't know how critical it is for people to get, and people that don't get it will get wiped out in no time. It's like saying, I think the market should be this, and I'm going to argue with the markets to trade and hope for a profit. Well, guess what? You can't trade like that, because the market will present itself saying, these are the times when you go in with this opportunity potentially opening up. That's when you trade. Let me give you some further examples, because I don't even know where to start. Let's see, where do we go? I'll just go through one by one. Okay, so let's say in this article, I see this all the time. I even seen it with Ernie Chan. We live in this era of low volatility, and people think it's on forever. Well, if you look at the stats of volatility since, let's say, the 50s, guess what? Volatility has always been low. And you can't blame it in the last 5-6 years since 2008. Volatility has always been low. It's just for a while before '08, you had quite enough volatility to trade off of. But everybody pretty well is a slave to volatility. So there is a real reason why retail traders lose money, because there's a number of things. Let's say only 20% of the time in the markets historically are the right times to trade on a short-term basis, meaning if you trade as a day trader across all the time, 100% of the time, you're going to get wiped out, or at best, you'll break even. Because you have to factor in transaction costs, you have to factor in volatility, and how on the long run volatility can work against you. I got all these articles explain all this. Like in here, there's different examples with the VIX versus your historical volatility, and what happens if your VIX falls 25%, all the different conditions to understand when to trade as a short-term day trader. Meaning, if you're going in as a short-term day trader, you're only going to hold positions for 1 to 2, maybe 3 days, maybe for hours, and that's where your intraday high-frequency trading may come into play. But 80% of the time, okay, that you're trading is just sitting around and balancing portfolios, and also putting in positions that are really long-term trades of like 30 to 90 days versus short-term trading of 1 to 3 days. It's critical that people understand this, because the market will tell you, based around volatility, not just on the volatility generally, like on VIX, but there's volatility on things like volatility on the index that you follow, be it a commodity, be it an exchange type of index, obviously like an S&P 500 or a FTSE, right? So those opportunities will present themselves, but 80% of the time, most conditions day to day are not where you are able to trade on a long-term basis. It's just, it doesn't work, because you'll lose money in the long run. Now, the reason things like automated trading come into play is really, really important to understand. But I've listed here the 4 reasons why most day traders or retail traders lose money is because, as I said, they don't have an appreciation for when the market presents opportunities. There's no systematic process that they have to allow themselves to understand when market conditions do change. They also have an unrealistic expectation of volatility when it's too low. And as I said, they're always day trading. And most of all, especially the retirees is a good example of this. They're always trading on older news or current news. Well, guess what? True traders and professional traders are trading on things that are going to happen in 30 days or 90 days. They're not trading on old news or current news, because majority of those retail traders allow the professional traders that see the markets 30 to 90 days down the line, they provide that liquidity to exit those market opportunities that they laid out 30 to 90 days forward. Also, most of these retirees or retail traders are only using technical analysis indicators exclusively. They're not looking at other things to understand the opportunities that are being presented. Because there's different types of news flow that you need to understand, and the news flow determines all your different volatility conditions, be it if it's forex, if it's a commodity, be it if it's a bond or a fixed income situation, and it's also broken down by region, be it in Europe, US, or China. So there's different weightings to be applied to each and every one of these scenarios. When you look at volatility, there's areas that impact the volatility. I'm not going to get into this in greater detail, but it's so important. And you can also use the average true range on each asset that you're looking at to determine the forward-looking of that volatility, among other things. Another area that's really important is the Kelly Criterion, to understand self-awareness. A lot of traders think they're good traders, and usually they're probably pretty crappy without them knowing it. I've never seen this before except in Ernie Chan's book. I believe that he's using Kelly Criterion as his way of assessing risk management. This is just one way of assessing your total risk management. But in order to specifically with the Kelly Criterion, what you're doing is you're using this formula, which is pretty simple. You take your winning trade minus your losing trades, and you divide by the win-loss ratio, okay? So if your winning probability is high, that means, hey, your trading ideas, your screening process may be good. But if your ratio on your win-loss ratio is poor, that means you're doing a really crappy job on your capital allocation management. That is pretty critical. So again, as you can see in here, there's trigger points on when to reduce capital to yourself or to add capital to yourself. I'm not going to go into details on that. So there's different ratios that you can factor, especially on your winning ratio, where you want your ratio to be more than 2. Okay, these are things I've never seen before, and it's so critical. So we cover that. We've covered. And I'll get this to a minute. Now, you need to apply discipline as part of your risk management. And again, as it says here, you need to be able to apply it to long-term trading. And there's different examples that I provide here on what to allocate based upon your margin when you open up your account, and how the broker looks at your trading account when you win or you lose. So I talk about that here, and especially on your exposure and your margin limits. And of course, when it comes to your margin, you don't want to be more than 1 to 10 times on large cap and mid cap, 7 to 8 times exposure or margin on your forex and commodity, up to 5 to 6 times. So there's upper ranges that you apply to yourself to make sure that you are not putting yourself in dangerous levels of margin, so you don't get dreaded margin calls, I guess. So I provide examples of that. Also, some of the other parameters that you need to apply are things like net exposure limits. There's also, I believe, some other limits on yourself, on your portfolio. And then also you can use beta hedging and apply a beta hedge view to assess your risk. And if you want to read through this, by all means. But here's just another reason why you need to apply these parameters. And again, these roll, these adjust probably maybe every day, every week. So to do this manually would take a lot of time again, and to apply it against your total portfolio. Because you're able to do it if you use automated trading, there's ways to allocate and readjust and recalibrate your portfolio, all your trades with your stop losses against these self-adjusting risk management parameters. So because of automated trading, that enables you to do that. And if you try to do it manually, you're going to run into problems. But the key here is that you, as a successful trader, you don't want to trade as a human. You want to trade like a non-human or an automated way. Again, I've applied this all the more reason with automated trading. I'll explain that in a minute. There's the psychology of trading, and this is where a lot of retail traders get clobbered by the markets, especially when you apply your positions. So there are critical reasons why you definitely need to automate versus be just a retail manual trader on your execution. So again, in order to succeed with this risk management, these set of risk management principles, you need to trade as a non-human. In other words, automate your trade. So let's say, for instance, you apply your average true range to stop losses. So let's say you're going to apply a short and a long. You have a ratio of 1.3 to apply, and you also apply a soft target. and that's applied to the whole life of the trade. You also need to analyze the volatility as part of the stop loss and calculation of the soft target. So what you're doing is you set up a risk reward on your new spread position. There's different outcomes that you need to play with for different outcomes. So what you're trying to do is you're trying to, as I said, apply hard stop losses and soft targets. This is critical. You need to also have not wide enough on your stop loss, so you're not going to use bad discipline. So there's different examples here. Applying your stop loss ratio, maybe 10%, let's say, but that can readjust based upon numerous calculations. Now again, this calibrates probably every day, every week. To do this manually, you would definitely be just running through many hours to do this. But here's the thing: stop losses guarantee your downside. But if you apply a soft target, you're not guaranteeing your upside. So let's say you are in a winning trade with the upside. What you want to do is you want to increase your risk by adding more to the position. So let's say you look at your PMI and it shows that you're in a bullish mode. You want to calculate your monthly volatility. When you long and short, you want to find ways to hedge out the market and sector risk. You want to calculate your implied volatility. I've shown videos and different ways to do that in past blog postings. It's just the idea is to reduce as much market and sector volatility. So if you added or had a perfect no news impact day, you'll find that your markets may move up 1% versus a short versus, let's say, 1.5%. It'll cancel out all your price movement, volatility, blah, blah, blah. I'm not going to get into that here. There's different steps that you can apply to this, different examples that I provide. Now, here's the important part for retail traders. Again, by applying these rules on your stop loss and your spreads and all these different targets, as a non-human trader, it prevents you from having long-term failure, basically on profitability. You'll lose money otherwise over the long run if you don't follow any of these principles. Now, what's being said here, you'll always have winners in your portfolio, so you don't have to worry too much about your losers, which you're going to have. But the key is knowing when to cut them, to sell off, to minimize those risks. That's really important. And honestly, automated trading is probably the only way to do that, because you're automated trading, you're taking out all the guilt of when you do remove your losing trades. And that's part of the benefits of systematic trading or automated trading, removes those kind of emotions. So you're not totally tied back to a position when it goes against you. Now, if you follow these principles, you'll definitely make more money in the long run. So why wouldn't you do that? But of course, ego and all that plays into it. So that's where and why a lot of retail traders get clobbered. And again, markets don't care about your positions or your profitability. They don't care. And why would they? So, as I said, there's numerous reasons to have soft targets and hard stop losses. You can have it on a rolling basis, which is obviously generated by automated trading. And usually another thing that a lot of traders don't realize is if you do have a running trade, you may use your stop loss to knock you out of the market for profit, But what happens if you want to maximize that profitability or that profit opportunity? You want to know when and how to apply new positions on that rally, right? You don't want to end it too prematurely. Now, there's some ratios where you have your stop loss ratio percent of between 7 to 12%. And as I said, you do an ATR range of 3 months, up to 3 months, and applying this 1 to 3 ratio, which will bring you up to about 21 to 30% as a soft target. Now again, I don't know how to stress it. You need to understand these principles, because if you don't apply them, these are your risk reward that you apply in your positions when you are currently trading. Okay, and this is spread trading, of course, and seems that spread trading is what most traders use. How do I know? I see it all the time in media outlets like Bloomberg and Morningstar, and probably CNBC as well. So again, let's say, as I said, the markets will present opportunities to you. Guess what? In this case, they will present to you that you have a winning trade. Don't mess with it. But you need to know how to maximize that opportunity. Okay. And because you're using automated, as I said, you get rid of the losers sooner. So that reduces your risk. And what you're doing over the long run with automated trading versus let's call it manual trading, you'll add more positive wins than keeping bigger losers on your portfolio. Okay, so that's one. Let's see, I put another posting on day trading. Let me just show you. Yeah. There's this one as well. I may have missed this. Yeah, okay. So I think we talked about this. Yeah, we did. So all these are really important principles. They are in this posting here, which the YouTube video will point you to. So this is critical stuff, and that's why automated trading is critical. This is basically going to be the nerve center of my new upcoming trading system. I won't be putting this out to the public domain at all, but I will have an alert service built around this as part of my memberships and stuff. So be on the lookout for that. But I thought I'd put this video series together as a critical plea for you to understand this if you truly want to stay profitable in the long run without giving up, because I get messages all the time. Why am I losing money? I'm ready to give up. And this is one of the reasons. And as I said here, it's because we, right now, guys like me, and gals, I guess, we get caught up in shiny new toys. Woo, yeah. All this HFT, buzzwordy stuff with the software, the quant programming, all this tech stuff, all the math. Or you're just lazy, maybe just plain ignorant and a stock chaser. But you got to apply these principles that I've been talking about for the last half hour, and read them, understand them, and apply them to some form of an automated trading system. Okay, hopefully you get it, and maybe this may change your thinking on things, or maybe, hey, you're just an expert and you're always profiting. Great. Have a good day.